You are listening to Keystone's Stock Talk Podcast, episode 65. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We have a special edition for you this week. We feature an interview with Aaron Dunn, Keystone's VP and Senior Income and U.S. Analyst. Aaron discusses Keystone's small cap, dividend growth, and U.S. equity strategies. He highlights 6 buy recommendations from our current coverage and takes a few viewer questions. Aaron also gives his brief take on the Canadian cannabis industry and the potential for an oversupply situation. Stocks discussed include Brookfield Infrastructure Partners, BIP.UN on the TSX, Boyd Group Income Fund, BYD.UN on the TSX, goeasy, symbol GSY on the TSX, EPAM Systems, EPAM on the NASDAQ, Zynex Inc, ZYXI on the NASDAQ, Microsoft Corporation, MSFT on the NASDAQ, and Parkland Fuel Corporation, PKI on the TSX. Aaron answers viewer questions on Evertz Technologies Limited, ET on the TSX, XPEL Technologies, DAP.U on the TSX Venture, and Viemed Healthcare Inc, VMD on the TSX.
Welcome to this live edition of Capital Ideas TV. Our guest is Aaron Dunn, Senior Analyst at Keystone Financial. We'll get to him in just a moment. Before we get started, if you are not already subscribed to our YouTube channel, we'd like to ask you to click the subscribe button, share today's show with anyone you think might be interested, and make sure you like this live stream by pressing the thumbs up icon. All of this helps us continue to produce these shows for you. If you have a question for Aaron, write it in the chat section on the right side of your screen. Now, Keystone Financial is an independent stock research advisory for do-it-yourself investors. Aaron and his colleague Ryan Irvine regularly analyze thousands of companies to come up with the best underfollowed, profitable companies that offer growth at a reasonable price. Now, Keystone's track record is impressive to say the least. We're going to have a look at it here. Their income stock hybrid portfolio since 2011 is up by nearly 16%. Over that time, the TSX higher by 4.3%. Its Canadian small cap growth portfolio since 1998 on an average basis annually higher by more than 36%. You can't argue with that. And its U.S. growth stock research portfolio, which it started in 2015, higher by 19.4% on an annual basis since 2016 being the first full year. Now, Keystone and Capital Ideas are also pleased to announce some special offers to Keystone Services. We'll bring you those later on in the show. First up, let's get a look at Aaron Dunn's bio board. He's Senior Analyst at Keystone Financial. He's got his CFA designation. From an educational standpoint, Aaron attended Royal Roads University and the BC Institute of Technology, and he blogs regularly at Superhuman Investing. He is very interested in technology and has lots of information and opinion on that. And here he is. Hello, sir.
Hello.
Very nice to see you.
Well, glad to be here.
You're fresh in from a seminar in Kitchener?
Yes, this is the 4th week of doing seminars across the country, so we're going to do another one tonight. We're doing another one in Oakville tomorrow, and then we're finished for a couple of months, so I think I'll take a vacation.
Well deserved.
Lots of fun, though. Lots of fun. We always enjoy it.
Yeah, for sure. Now, we've had Ryan in here before, as you know, your colleague Ryan Irvine, and one thing I'm always interested in, and I always ask, is that how the heck do you review something like 35,000 companies every year, which you do? And Ryan says it's a multi-month process to narrow it down to the stocks that you want to recommend for your subscribers. How do you actually do that?
Well, we love what we do, and we don't have lives really, obviously, outside of doing research. But we have a certain criteria. And we go through these companies, and if they don't hit that criteria, then we just move on to the next company. So for a lot of businesses, you can really get through quite a few of them quickly. So for example, if the company is not generating profitability, we don't even go to the next stage. We're not interested in speculating on what the company may be able to do in a couple of years. We want to see a company that has a good track record of producing profits, producing growth, and it's operating in a business where we see that growth as being sustainable. A lot of companies can produce a good year of profitability, and then the next year it drops off, and that's not the type of business that we're looking for. We want to understand the business model, and we want to see a business model that is viable several years into the future. So it really just takes a lot of time. Warren Buffett, there's a story that Warren Buffett once talked about where a young money manager came to him and said, Warren, I want to be a great investor like you. What do I do? And Warren said, you need to learn a little bit about every single company that trades on the stock market. And the money manager replied, he said, Warren, but there's over 10,000 companies and I need to look at. And Warren said, start with the A's. So that's what we do. We start with the A's and we go through everything. And after doing this for 15 years, you tend to learn a lot about the companies that are out there and what to look for.
Okay, we're getting a bit of flavor as to what Keystone Financial is all about. Can you give us sort of flesh out more of an overview of Keystone Financial and what you offer to investors?
Sure, absolutely. So what we are is we're individual stock pickers. So we do the research, we find individual companies that we believe provide great value to investors, and then we recommend those stocks to our clients. And we do this in three specific areas. So the longest standing research service is our small cap research that goes back to 1998. So these are smaller unknown companies, but highly profitable, growing, good, solid businesses that can be acquired at an attractive price. And really often what we're looking for in this market are companies that the rest of the market is not well accustomed with, that they don't know much about. So we find these companies, these underfollowed businesses, recommend them. Roughly around the time of the financial crisis, we saw an opportunity to start getting into dividend growth stocks as well. So we started our income research service, essentially looking at every dividend paying stock in Canada, making recommendations that are divided into three different risk categories. So conservative stocks, these are large cap, more stable businesses, all the way down to small cap dividend growth stocks. And if you look at the data on dividend investing, we really discovered that you absolutely have to be successful, to have a good, solid portfolio, robust portfolio, you need to have some exposure to dividend producing companies. The data is, I mean, it's absolutely convincing. These companies outperform over time. So we thought this was a great area to explore for our clients, and we started doing that in 2009 is when we came up with that service. And then more recently in 2015, we started looking down to the US. And then once again, we based this decision on the data. Canadians really have to look outside of their home country if they want to have a diversified portfolio. We're so overly exposed here into two sectors, which are financials and resources. And if you look at financials, over half of that is just the big six Canadian banks. If you look at resources, that's mining, oil and gas, highly cyclical, commodity-dependent businesses, and not companies that we see as long-term investments. But then you look at technology, that's only about 5% of the Canadian stock market. So there's just far greater breadth and diversity of opportunities in the US. So we started exploring down in that area in 2015 with our US growth stock service. And we found some amazing companies that just absolutely don't exist up here in Canada.
Now, Aaron Dunn, Senior Analyst with Keystone Financial, has 6 top picks for you today. And each of these are in those categories. It's either growth, it's dividend, it's U.S., maybe a combination of the two. All right, so you touched on some of those areas there in terms of the criteria that you're looking for. It seems like you've got maybe, say, 7 pillars. You don't have to go through them all, but I noticed on your website there are absolute keys that you have to see in a company before you buy it. And if they're not there, then it could be a red flag and you're gone. So So expand on that.
So absolutely. So the first thing that we look at when we're analyzing a company is really simple. Is it even generating any revenue? And that might seem like a simple criteria, but the fact of the matter is a very high percentage of the companies in Canada, publicly traded companies, don't even generate a dime of revenue or what we would consider meaningful revenue. So we look at that revenue line. If there's nothing there, no point in doing any more research. Past that, we look at profitability. So we believe the purpose, of course, of a business is to generate a profit. And if a company is not generating a profit, or we don't see a very quick pathway to profitability over the next year, then we see far too much risk in that company. So revenue, profitability. Beyond that, we're looking for growth. So it's really growth in earnings per share that we believe is going to drive the long-term share price performance of a company. So we want to see that a company has been growing their revenues, growing their earnings per share. We want to see that a company is well capitalized, so it doesn't have too much debt on its balance sheet. We really love companies that have net cash positions, so more cash than they have debt, because this puts them in a great position to withstand any type of adverse conditions in the economy, and also buy other businesses or invest in their own business. So strong balance sheet is an absolute must for us. If there is some debt, then it has to be a manageable amount. And then beyond that, it's really about understanding the business model, understanding the market that the company is operating in, and just making an assessment as to whether or not the growth is sustainable. Like, is this company going to remain profitable going into the future? Are they going to be able to continue to grow? Because the past performance is not necessarily indicative of the future performance, and that's something that we're very focused on, is just understanding, how does this business make money? What are the long-term growth drivers in the market they operate in? What does the competition look like? And just trying to get a sense of the visibility of financial performance going several years into the future. And what we really like to see are businesses that have some type of a catalyst for growth, so something that we can visibly see. And there's a couple companies that I'm going to talk about later today, and I'll dive into what those catalysts are, or what they were and why we recommended them. But it's really about having some type of visibility. You don't just want to make a guess. You want to understand what the drivers are in that company's business. And,
all right. Yes, sorry, go ahead.
Yeah, well, I was finished, but just understanding the business and understanding that it's going to continue to grow.
Okay, Aaron, that's a nice segue into some of your top picks. We'll kick it off here with Brookfield Infrastructure. This is on the TSX, BIP.UN. The Brookfield name, very well known, very well respected. So this is a bit of a larger cap than some of the stocks you're known for, and obviously has a yield. So why does Brookfield Infrastructure stand out here, and how much is management a key here? Because you always hear about how strong the management is at Brookfield in general.
Certainly. So Brookfield is a long-standing recommendation in our dividend, our income growth stock research. So we originally recommended the company in 2011, and what we like about it, it's a very diversified, very defensive business. So they're a global infrastructure company. They own assets all over the world. So these are low volatility, long life assets. Most of their revenue is contracted or regulated. So they have great visibility in terms of what their revenue and cash flow generation is going to be. Also very well situated in the event that we enter into a recession. They're not going to have a lot of volatility in their financial performance. But beyond being a great defensive company, it's also been a great growth stock. So consistent growth over the time that we recommended them in cash flow per unit, in low double digits, about 11-12% growth on average over that period of time. They pay a really nice yield, about 4.5% right now. And they grow that yield every year at about 11-12% as well. So we like the business. We like to find businesses that have, as I'd said before, that great track record. We've seen them grow in the past. We've seen management in action, and they've really provided amazing value for shareholders. What really impresses me about Brookfield is over the 8 years that we recommended them, we initiated our coverage at a price of $14.41 per unit. They have paid out over that period of time over $11 US in income distributions to their investors. So that is a huge flow of income that has gone right into investors' pockets, almost equaling our original purchase price on a pre-tax basis. I mean, you look at a company that is far less risky than the market average, but is returning generating a far greater return than the market, and that's something that you need to pay attention to. But looking forward, we still see great growth from the company long term. So over the last year, their cash flow is actually flat from 2017 to 2018. One of the reasons for that is that they sold several of their assets, some of their more mature assets, in order to reinvest in higher growth assets. So we expect growth to start picking up again in the latter half of this year. Q4 of last year was reasonably strong. They just put out the first quarter. There was some growth there as well, single-digit growth. But we're looking at double-digit growth returning in the second half of this year. And it's just a great, robust business that also provides growth to your portfolio.
All right, very good. Brookfield Infrastructure, a top pick of Aaron Dunn. TSX, BIP.UN is the ticker on that one. Let's move along to another one here. And this goes to a point that you made earlier that past performance is not necessarily indicative of future performance, although with Boyd, it usually is. Boyd Group Income Fund on the TSX, BYD.UN is the ticker. Now, the story here, and you can tell it better, but that KeyStone's been recommending this for years, and it's up something like more than 4,500% since then. And I know that you've had clients come to you, or members, subscribers. I mean, look at that chart. Unbelievable, because we purposely built a longer-term chart here to show you how well Boyd has done. But I understand you've had clients come to you who say, well, why are you recommending this at 20 when it's already doubled? Why 40 or why 60 when it's already doubled and tripled? And basically, you do your research and you look at Boyd, and they're continuing to execute, and so you're going to continue to recommend it. So tell us about Boyd. Give us an update now.
Yeah, so I'll just to answer your question about why would you recommend a company that's gone up so much? Well, the fact that it's gone up so much is really a good indication that they've been great executors. And whenever you look at a company, whether you're looking at it for the first time or whether you've been covering the company for 10 years, you really need to try and look at it with fresh eyes. So regardless of what it's done in the past, you need to look at it from the perspective of what would I think about this company if I were to discover it for the first time today. So looking at Boyd right now, I mean, it's been an absolutely amazing story. We recommended it shortly after the financial crisis because we saw it as a recession-resistant business. So there is nothing exciting about auto body and glass repair, but what we found exciting about it was that the company was generating lots of cash flow, they were growing their revenue, and 90% of the payments that they receive from their clients are from insurance companies. So when you get a dent on your car or a rock hits your windshield, it doesn't matter if it's a recession or not, it's insured anyways. You bring it to a company like Boyd, they repair it, they make money. So they're a huge consolidator of the auto body and glass repair business across North America. They have about 611 shops right now, and that just continues to grow and grow. There is a market of 32,000 shops throughout North America, and with 600 shops, Boyd is one of the largest players. So that just gives you a sense for how fragmented this business is. They estimate that it's worth about $40 billion US. In the United States. So they're continuing to grow. There's lots of space for them to grow. The financial performance continues to be amazingly strong. Their adjusted free cash flow for last year was about $778. It was up 56% from the year before. So amazing growth, about 20% growth in revenues in the last year. And they're going to be coming out with their first quarter shortly. We're expecting that growth to continue. So as long as they keep executing on their strategy, which is to consolidate their industry, and the success of that strategy is evident in the financial performance of the business, then it's something that interests us. And then the final ingredient, of course, is valuation. It's great. It's easy to find a great business, but where the art of financial analysis comes into play is not overpaying for that business. So we're looking to buy companies at a reasonable price. And Boyd right now trades for about 20 times adjusted free cash flow, about 35 times earnings. So this is not a cheap valuation, but relative to the growth that the company is generating and the market that they're consolidating, we still find it reasonable. And that's why we continue to recommend it, even though it is gone up, about 50% over the last year or more.
All right, very good. Boyd Group Income Fund, number 2 top pick from Aaron Dunn, Senior Analyst at KeyStone Financial, a real winner for KeyStone and their subscribers over the years. Now, we're going to get back to Aaron in just a moment. He'll take some of your questions. We're monitoring the chat here. We've got Tim Tidwell with a question, Dean A., and others. We appreciate that. We'll get to some of those in just a while, and we're going to see if Aaron can talk about them. Now, if you're just joining us, remember to subscribe to our YouTube channel. And if you're already a subscriber, make sure you have the notification bell turned on so you can be the first to know about new videos and live events. Now, I mentioned a special offer from KeyStone. What you have to do is go to keystocks.com and register, and you'll get a discount on Keystone services, plus their 2019 Canadian Dividend Growth stock report completely free. That's got a value of $599. A lot of work has gone into that. Basically, Aaron and Ryan have analyzed about 450 dividend payers on the TSX. They've narrowed it down to the top 30, so you get those, and then they drill even deeper and provide you with the best 3 to 6 dividend stocks to buy right now. Now, last week we had Bruce Campbell on the show. He's the founder of Stonecastle Investment Management. He had 5 top picks for you, and one of them is Name Silo Technologies. We thought this would be interesting to revisit because it's a interesting name that you may not have heard of. I certainly hadn't. So here's what he had to say about Name Silo Technologies.
So it's a fairly new company to us, and when we met with management, we didn't know too much about it as well. But when you take a look at Tucows or GoDaddy as examples, those have been, fairly steady cash flow machines. People always joke about Tucows being, one of their cash cows being the domain registry business because it just, continues to kick off cash flow. Most people, when they register a domain, aren't canceling it or switching it very often. And so if you can get those clients signed up, then, just reoccurring revenue. Name Silo has been doing so very much from an organic standpoint and doing it without a lot of advertising. Quite often the acquisition cost per customer is extremely high in this business. If you watch TV, you're constantly seeing GoDaddy advertising on TV to try to get those customers. That's very expensive. It usually costs more in the first year than they actually receive in revenue. In Name Silo's case, they haven't been actually advertising, but they've been still continue to grow. Their compounded growth rate is around 70% per year over the last 5 years, and we think that that's going to continue. They've just recently announced that they're going to be actually going into some of the ancillary businesses as well. So to actually host the website and also to provide email. And of course, this would be fairly simple for most of the people who take on new websites to just have them do it immediately for them. So that's extra revenue for them. Again, they probably won't have to pay a whole lot to acquire that revenue, and it basically will drop right to the bottom line. I mean, there'll obviously be some costs associated with, but it won't be certainly that expensive. So it's one that is small right now, but is really flying under the radar, and we think that over the next few years, if they continue to grow the way they have, it probably doesn't last. Chances are it gets taken out at some point in time because if you look at GoDaddy, they were bought by private equity just because they recognized the sheer magnitude of the cash flow that's kicked off there. And then if you look at Tucows, I mean, they obviously have other businesses beyond just the domain registry, but it's been a great performer as well over the years.
We are back with Aaron Dunn, Senior Analyst at KeyStone Financial. He's got some more top picks for you, and he's taking questions as well. Now, if you're enjoying this show, make sure to click the thumbs up button below. We would appreciate that. So we want to start with a company that we were just talking about off-air briefly that I remember. I've never owned it, never really followed it that closely, but I know that their technology was used by BNN Bloomberg when I worked there back in the day. So remind us what they do. We've got a question here on Evertz, which I believe came through our YouTube channel. So Evertz Technologies, television equipment essentially. So
yeah, essentially telecommunications equipment. It's a company we've been following for a while. There are some things I like about it. It's not a recommendation to our clients. I myself consider it more of a hold right now, maybe a longer term buy. So a few things that I like about the company. One, it is a highly profitable business. Stable business, absolutely. It is operating in a market where there are some good long-term growth drivers. Net cash, it has a nice net cash balance, which we also love to see. I believe that net cash is about 20% of the market cap, so fairly significant there. But the one thing that has made us shy away, I've spoken with management a couple times, we've been close to a recommendation, but the one thing that has made me shy away from the company is they just haven't been able to generate consistent quarterly growth in earnings per share over time. So as I said, earnings have been fairly stable over the past several years, but just not really a lot of growth. Sometimes you'll see a quarter or two where growth will tick up, but then you can see a quarter or two after that where growth will decline. So it's a very contract-oriented business, and if they execute on a few contracts in a particular quarter, then that'll be a better quarter. But we tend to like companies where we just have better visibility and just a smoother uptrend of growth over time. So it's not a buy for us, but certainly it's a great business, and I know the last couple of quarters have been strong. So something we would look at again over time.
Is it a lumpy business, or is the type of business that's consistent? There are always television companies looking for new equipment.
Lumpy in terms of growth, not lumpy in terms of profitability. The profitability is actually very consistent. Yeah, but in terms of growth, the growth can change from quarter to quarter.
We're looking at Evertz here over the course of the last year, starting at around $17.50 about a year ago, right around there. It's essentially flat over that time, and mostly down during that period. So that's Aaron's take on Evertz Technologies. Thanks for that. We're going to move ahead to another question here, and this came from Tim Tidwell on goeasy. Now, we spoke to the CEO here more than a year ago. Mr. Ingram or Graham? Ingram, I think. David Ingram. And I have to say, he was one of the more impressive guests in terms of CEOs coming in here. If you go to a casting call, he's the guy you would cast as a CEO. He just sort of exudes CEO. I was impressed by him. So tell us about goeasy, the alternative lender. What do you think of them?
It's actually a business that I've come to like recently. I've followed this company for a while. I've not recommended them in the past because I've been a little bit worried about their business. So essentially the main component of their business is subprime consumer loans. So these are non-collateralized loans basically to subprime high-risk borrowers. They essentially loan money to people at about a rate of about 43% on average. So you think of who's willing to pay a rate like that, and it just made me a little cautious about recommending the company. But I've looked at their long-term track record. The CEO is great. I mean, they do a great job on the conference calls, communicating their story and some of the risks and the growth. But it has just been an absolutely great growth story over the past several years. And even when the market, even when the economy started to decline in Alberta, with the oil patch declines there, they were still unfazed by that. They continue to do well in their markets. So it's a type of business that I think is higher risk, absolutely. But looking at the company's growth profile, looking at their valuation, trading about I think about 9 times, 8 times expected earnings over the next year, I think it's quite a good business. So we've opened up coverage on it to our clients. I told my clients, start off with a half position, see how things go. But it's you can't really argue with the track record that these guys have demonstrated. So I like it.
All right, very good. That's goeasy, and we were looking at a 1 year. You don't necessarily see the growth in that 1 year chart, but certainly going back 5 years and longer, it has done very well. Now, we do have questions on Zynex, and I can tell you, Dean A., that we'll have Aaron talking about Zynex later on in the show. Also, Viemed is coming in terms of an answer from Aaron. Enwave he cannot talk about. Thanks for your question, Walter Leipzig. And Acuity Ads he cannot talk about, but thanks for that, Ray YouTube. Now, let's get to another one here from Tim, and he wants to know about EPAM on the NASDAQ. What's the full name of that company?
EPAM Systems.
It's called EPAM.
EPAM
okay.
Systems,
right.
So EPAM's the ticker, trades on the NASDAQ. So this is a fantastic company, actually. We don't have a buy recommendation on it right now. We did have a buy recommendation on it last year. Recommended it about $120 a share. I think it's upwards at about $180 right now, or $175. So essentially what this is a software engineering company. So this is the type of company that helps large-scale enterprises modernize and digitalize their operations. So if you're a manufacturing company, global manufacturing company, you want to investigate how automation can improve your business, or you want to implement, you're a company that wants to implement a private blockchain into your business to become more profitable, artificial intelligence, machine learning. these are the people with the expertise to help you do that. So I've always said, when you're looking at some of these key technology trends like AI, machine learning, blockchain, it's not the companies that call themselves an AI company that are necessarily the places that you want to invest. It's companies like EPAM that are real businesses with the experts that are helping other businesses implement these technologies so that their customers can be more profitable and more efficient and more competitive. So we like the company. The only complaint I have about it, I mean, it's generated absolutely fantastic growth. They're estimating, I believe, about 15% growth going into next year. They trade right now at about 35 times adjusted earnings, 40 times adjusted earnings. So the valuation has become more expensive, I'd say, over the last six months or so. Long term, I think it's a great stock. I don't think it's a screaming buy at this point in time just due to valuation. But if you don't mind paying a premium valuation, a little higher of a valuation, then it could be something that you'd get into maybe on a 5-year time horizon. I would just say, just talking about valuation and how we look at it. When we recommended the company, it was growing at a higher rate, about 25-30%. They always seem to underpromise and overdeliver. So when they're saying 15% earnings growth next year, I mean, a company like EPAM could potentially double that, in which case a 35 times multiple is not unreasonable at all. But just looking at 15% growth, 30, 40 times earnings, it's not bad. It's not completely unreasonable. We would potentially look at it closer again on a say a 10, 50% pullback.
Okay, just quickly here, Tim Tidwell, who asked that question on EPAM, more specifically, he said he bought it on your recommendation. It's up about 50% since then, so hold on to it here?
Oh yeah, I would hold on to it. Yeah,
okay.
No, we wouldn't be in a hurry to sell it at all. Yeah, it's probably at this point, it's closer to a buy than it would be to a sell.
All right.
Yeah.
Now, back to top picks here. How about Zynex Medical? We did get a question here in the chat about Zynex Medical on the NASDAQ. This is ZYXI. Electrotherapy devices is what they specialize in. So how did you find this one, and tell us about Zynex?
So yeah, this is a great example of an underfollowed company from our U.S. growth stock research. It's performed fantastic. So we found this company when it was trading on the OTC bulletin boards, largely unknown, one of the few profitable growing businesses that traded on the OTC at the time. And a lot of professional money managers will stay away from the OTC because there's lower disclosure requirements, so there's a higher level of risk. But we did our due diligence. We liked the business. We liked the financial performance. Had net cash on the balance sheet, so we recommended them. And earlier this year, they upgraded to the NASDAQ, and that's really what we want to see for these profitable businesses on the OTC, is an upgrade to the NASDAQ. And I wanted to recommend this as a current buy on the show today, but it's actually popped up about 30+%.
Yeah, we're looking at that. They just had earnings, right?
They just had earnings, yeah, about a week ago, and the earnings exceeded expectations. Now that they're on the NASDAQ, they have much greater visibility surrounding the business. So it's definitely a solid company. We'd look probably for a 10-15% pullback in the share price, but we're not at all in a hurry to sell it right now because they're continuing to grow. They once again, they have a great balance sheet, and they traded about 23, 24 times trailing earnings, which, given the growth rate, isn't that bad, but it is still a smaller cap company, and they're building visibility in the market right now. So we're just being, we've already got our clients in, so we're just being cautious. We're being patient. What they do is, like as you said, they're a medical devices company, electrotherapy products, and that's for chronic pain management. So this is essentially a substitute for pain drugs that are highly addictive. And if you think about the opioid crisis, right, and all the problems that creates, a company like Zynex definitely has a future. And this isn't the type of pain management product that you would buy in an infomercial. These are actually doctor prescribed products. So it's a very legitimate tested product, and successful. They're gaining market share, and they're doing very well.
And a great looking stock chart, as you saw there on Zynex Medical. But as Aaron said, he'd like to see a 10 to 50% pullback before he recommends the stock again in terms of buying it. Now, here's a top pick that's interesting. One of the biggest companies in the world, Microsoft, on the NASDAQ, MSFT. You probably know that. Now, what's interesting here is that when Steve Ballmer was running it, it just kind of fumbled around. as a business, and the stock just went sideways. Satya Nadella comes in, institutes this plan, decides to go deeper into cloud and do all sorts of other things. Stock's done tremendously well. So what are you seeing in Microsoft that you find appealing?
You basically said it. I mean, one of the main things that attracted us to Microsoft was that they're killing it in the cloud computing space. They have the second largest market share in the cloud computing space after Amazon, but they're growing market share at a far faster rate than any of their competitors. So I've personally used their Azure cloud platform. I've used Amazon's AWS platform. I like Microsoft. I like their Azure platform. It's much more user-friendly, so I can see why it's gaining market share. But really, it's some people refer to it as the evil empire. I just think it's a great business. They're mostly known for their Office products and their Windows. And that's kind of why the company stagnated for a while, because there wasn't really a lot of innovation. But they're really innovating now, and they're changing the way they do business. And they're in a lot of different areas that people don't really associate them with. So, for example, they own LinkedIn, the largest social media platform for professionals. They own Xbox, which is the second largest market share gaming platform in the world.
Sorry, can I stop you there? Has LinkedIn been successful for them, and do they break those numbers out in their earnings?
They do not break that out specifically, no. But when you look at a company like Microsoft, they're in so many different places. Certain aspects of their business will support other aspects of their business, and a lot of time it basically comes down to data as well, in terms of how they can use the data to support other areas. Other areas of their business, but they're in a lot of different spaces right now. Another thing that I like is that they've changed the way they sell their software from just a one-off licensing sale to a recurring revenue model. So in the past, you would buy, for example, Office 2014, you'd wait 2, 3, 4 years, and then you'd give them more money and you'd buy another version. Now they have their Office 365, so they're essentially renting their software out. That's a recurring revenue model that we like to see. Cloud is also recurring revenue for them as well. We love to see that, just in a lot of great areas. And I would say a very defensive software company as well, because they're so entrenched in their various markets. So this is the type of company that I would expect to perform better in a recession relative to their other software peers. But great financial performance across all their business segments over the past few years, and in the most recent quarters, double-digit mid-teen growth in revenue and earnings per share, which is what we like to see. And trading at what I believe to be a very reasonable valuation. So it's come up recently. We recommended it earlier this year at about 105. It's around 130 right now, so it's come up, but we still like it. It's trading at about 27 times next year's expected earnings. Well, if you look at software companies in the US that have the type of fundamentals that Microsoft has, typically you're paying 40, 50 times or much higher. So we see reasonable value with Microsoft, and we think it's really a best in breed in that area.
We had Microsoft as a cover story in our Capital Ideas Digest several months ago. You can find that on at capitalideasmedia.com. I think it was trading around 120 at that point. That was based on some research, and stock has sort of ebbed and flowed, but it's up since then. So that's another top pick from Aaron Dunn, Microsoft. And we have a question here from Ray YouTube, and I'm just going to throw this at you. If you can't answer it, you don't know the company, that's fine. But we also did a cover story on a company called Quisitive, which is a partner of Microsoft. Do you know that one at all? It's a microcap.
Not enough to really comment on it, no, unfortunately.
But apparently they have a relationship with Microsoft, and it's a favored partner, so to speak. Anyway, thanks for the question there, Ray YouTube. All right, moving along. Another top pick here. Parkland Fuel, PKI on the TSX. Here's a seemingly nice, safe, steady business?
Yeah, it's been a steady performer. So we recommended it in early 2018, and this is what, when I was talking about catalyst, this was really a catalyst story. We had followed the company for a few years before that. Good, stable business, but not really a lot of growth in free cash flow per share. But in late 2017, at the very end of 2017, they did 2 huge acquisitions that really promised to drive growth, and that was the catalyst for us to recommend the stock early next year. So we did that. They absolutely delivered on those acquisitions. Free cash flow, adjusted free cash flow per share doubled in 2018 to about $4.30 per share. They just recently put out their first quarter. It was a record quarter for the company. Free cash flow per share up about 11%. they do fuel distribution, petroleum product distribution, and refining, but they're in a lot of different places, from gas stations to refineries. They own the Burnaby refinery in British Columbia. They've also expanded into the U.S. They've expanded into the Caribbean. So they have a very wide-scale platform from which they can build on, and we're expecting to see more acquisitions in the future. But this, once again, is a story. You know, we've seen them execute several acquisitions. They've done it successfully. They've hit or exceeded their targets. So that gives us confidence in the management team that they're going to be able to do that again in the future.
And Aaron, you said you recommended that in early 2018. So the stock was trading at what?
$26 and change.
26. So now it's at, where are we now? You know, the 40s.
About 40,
yeah.
about 40, yeah. And of course, it pays a dividend as well. So right now, the yield is about 3%. It will grow. Likely, it will grow every year. Not at a large rate. I think low double digits is what they increased it at the beginning of this year. But just a very solid story.
All right, nicely done. So another top pick there from Aaron Dunn, Parkland Fuel. He also had Microsoft in this segment as a top pick and talked about Zynex Medical as well. Now, Aaron's going to sit tight. He'll take some more of your questions in just a moment. Another top pick to come. We want to remind you that Capital Ideas produces a free daily morning note that you can receive to your inbox to get you ready for your investing day. Go to capitalideasmedia.com to sign up for free. The morning note contains analyst initiations, upgrades, downgrades, stocks on the move, and news as well. Now, we also produce the weekly Capital Ideas Digest, which I was just talking about. That's where we curate investment ideas based on the research that we pay for to arm you with the information you need to amplify your returns. We're offering a free 30-day trial to the Capital Ideas Digest. You'll get free access to 4 new issues, plus access to our archive of digest. See what you're missing by going to capitalideasmedia.com/30-day trial. Now, another one of Bruce Campbell's top picks last week was Enwave Technologies. We had a question about Enwave. This is not a company that Aaron recommends or follows necessarily, but Bruce does. And here are his thoughts on that company. Why is this on your list, Bruce?
So this is one of those companies that's it's a 10-year overnight success. So they've been operating and just continually grinding it out in their business, and now they're really at the inflection point for what they're doing. And they have a drying technology that really allows you to do a lot of different things. So their sort of primary market that they've been in before is really in dehydrated.
And we are back. Apologies for some technical difficulties there. We're back with Aaron Dunn, Senior Analyst at KeyStone Financial. He's got one more top pick for you and taking questions as well. Now remember, if you're enjoying this show, hit the subscribe button and make sure you have the notification bell turned on so you'll never miss our new video uploads or live broadcasts where we give you access to some of the most savvy minds in investing, such as young Mr. Dunn here doing a great job for us today. Just looking at some questions here from Ray YouTube. What about the AKTS? Do you know that one? It's a 5G type company. I'm guessing it's on the NASDAQ?
No, actually, right now we're in the process of doing a 5G report for our U.S. growth stock service. So that might be a company that we come across right now, but I don't want to provide any comments unless I can be absolutely sure what I'm talking about. So
absolutely, no, that's completely fair. Well, I have you here. Speaking of reports, I believe you did most of the work on your 100-page cannabis report.
Yes.
Then am I right in saying that right now, when you look at the landscape, you look at all these companies, big and small, you don't find many that you would recommend?
Well, based on Keystone's research criteria, there's none that we would recommend at this point.
Not a single one?
Now, none of the Canadian producers are even close to being profitable. Now, I do expect this to change in the future, but we're not going to bet on what's going to happen in 2 or 3 years. We want to see profitability today. Now, there are some U.S. cannabis companies that are listed in Canada that are transitioning to profitability or have generated positive free cash flow. Typically, valuation is an issue there, but that is something that we're looking closer at. One of the things that we did discover when we were doing our research just on the market in general is that the Canadian domestic market has the potential to be massively oversupplied over the next couple of years. So people are talking a lot about a supply shortage in the near term, but the estimates are generally that the domestic consumption in Canada is about 800,000 to 1 million kilograms of cannabis per year over the next few years. And the top 10 producers alone are planning to ramp up their production to over 2.2 million kilograms of cannabis. That's just the top 10. That doesn't include any of the other 168 or so listed companies in Canada. So we're definitely, we see some risk in terms of there's going to be a small number of cannabis companies over the next several years that are going to be successful. Typically, we think that it's going to be the larger ones that are best positioned to compete, the Canopy Growths, the Auroras. They've proven that they can produce cannabis at a mass scale, high quality cannabis at a mass scale and a low price point. And they're also the best position to access the global market as that continues to grow. And if you listen to the interviews from Canopy and Aurora or some of the other big companies, I mean, they're quite forthcoming about the limited market that exists in Canada, and that the global market is really the true opportunity for them. But there's still a lot of uncertainty in that space, so it's not something that we're specifically attaching a buy recommendation to. If you want access to the cannabis market, then you know, companies like Canopy and Aurora are likely the best way to do that.
Now, you're looking for profitability, cash flow first, but in terms of a business model, in terms of the American ones, do you look at, say, an Acreage or a Harvest Health or Cresco? Do some of those names appeal to you?
Yeah, so a couple that we're looking at are TruLeaf, Charlotte's Web, MedMen. So TruLeaf, just for example, they generated about $7.8 million in cash flow in their most recent quarter. They're the first and largest producer and retailer of medicinal marijuana in the state of Florida. MedMen, they're a retailer of marijuana. So these are the companies that we're looking at right now in the U.S. space. They're just not quite hitting our criteria, but things always change very quickly, and cannabis is absolutely a legitimate market. So we're watching and we're looking for those opportunities. It's very important for us to stay consistent with our investment strategy. We really think that is where some analysts and particularly investors kind of go off course, is when they forget about, you know, what they're trying to do. They forget about adhering to their investment strategy, and they kind of buy into hype, and they get excited about something and invest off of that excitement. So what has made KeyStone successful over the years is a focus on profitability and growth, and that's what we're going to continue to do.
Just very quickly here, has Planet 13 hit your radar?
It's hit my radar, but it's just not there yet.
Okay.
Yeah.
We visited their facility in a couple of months ago, and it was quite interesting. The big retail facility in Las Vegas, and they're a client of ours, by the way. They compensated us for that interview and for an ad that we produced for them. But they are interesting. They're growing their sales, and be curious to see what you think of them down the road. Okay, let's get back to before we get to your last top pick, let's we have a viewer question here from I forget from who, to be honest, but it's on XPEL, DIP.UN.
XPEL.
I know this was one that Ryan talked about, big winner for you in 18, I guess it was 2018.
Yes, yep.
It's consolidating now, but it's been tremendous.
Yeah, so it's still a great company looking out long term. What they do is they do protective films for high-end cars. Really boring business. Nobody really paid attention to it when we recommended it originally, but once again, it was generating good, solid profit and cash flow. So financial performance is really what drove the share price over the last year. It has pulled back, and that just comes down to some challenges that they faced in China. Kind of an interesting story is they came up with a new protective coating that was actually thinner than their old protective coating. It was actually better, and they started selling that into China. But one of their competitors started a campaign against that, saying that the thinner coating meant that it was an inferior product, and they're trying to offload inferior product into the Chinese market. So that has impacted their sales. But what they've done is they're bringing back the thicker material to China, and we believe that's going to be successful long term. The next couple of quarters are going to be a little bit flat to slightly lower, but we still think that it's a good, solid company long term.
XPEL Technologies, and we're looking at a triple there on that stock, even more than that. And as Aaron mentioned, it's had a few issues, and it's consolidating, but he still likes it. All right, to your final top pick here, and this was a top pick actually of Bruce Campbell last week, Viemed Healthcare, VMD, on the TSX. I noticed they had earnings numbers come out the other day, record revenue, record earnings. It's a going concern. They seem to be doing well. Yeah,
they're doing great. So this is actually a company that I selected in replacement for Zynex, and they've actually come up a little bit since their Their quarter was released as well. But essentially what this is a home healthcare company in the United States. They operate exclusively in the U.S. What they do is they help patients with a respiratory disease primarily, and this is a big market and it's a growing market. It really feeds into the aging demographics and that story. So it's been a very successful business, about 40% compound revenue growth over the last 5 years. They generated about 40% revenue growth in their last quarter. They're estimating 10% growth quarter over quarter, so 45% year over year. So that trend just keeps continuing going forward. And this is just, once again, highly profitable business as well, about 18 cents per share in net cash. Profit did not grow in the first quarter, and the reason for that is they invested more heavily into expanding their sales force. But it's been a earnings per share grower as well, and we expect that's going to continue over the next perhaps not next quarter, but over the next few years here. So this is just another great example of a company that is benefiting from an attractive trend, which is the aging demographics and the healthcare costs that creates. Really home healthcare services, and we recommended a company a couple of years ago called Almost Family in the U.S. that got acquired, and we really love the home healthcare business in the United States because it's a way to save money. It's a way to reduce healthcare costs. And as more people age and the U.S. healthcare budget becomes more stressed, they're going to have to investigate ways to reduce those costs. So this is one way to do it. And we like Viemed going forward.
Okay, Viemed Healthcare is the last top pick today, but not least, from Aaron Dunn, VMD on the TSX. The other top picks from Aaron Dunn today, we had Parkland Fuel, PKI, on the TSX. You had Microsoft, that's on the NASDAQ, MSFT, Zynex Medical, ZYXI, but Aaron cautions that you probably don't want to buy it right around now. Maybe wait for a 10 to 15% pullback because it's had quite a run. Another top pick, continues to be a top pick, has been for more than 10 years probably, over at KeyStone Boyd Group Income Fund, BYD.UN on the TSX. And lastly, Brookfield Infrastructure, and the ticker there is BIP.UN. This was fun. Great stuff.
I had a great time.
Excellent.
Absolutely
great time. So much, you're not tired of talking after this
No,
seminar?
I could go on for another couple of hours.
Yeah, that was excellent. Fantastic information, and great to finally meet you, and we'll do it again.
Fantastic. Looking forward to it.
Okay, thanks, Aaron. And now as we wrap things up, a reminder of the special offer from Keystone Financial. Don't go away yet. This is worth listening to. Go to keystocks.com, register, and you'll receive special discounts on their services. Plus, you get completely free their 2019 Canadian Dividend Growth Stock Report, which has a value of $599. Basically, what Aaron and Ryan Irvine do is analyze 450 dividend payers on the TSX. They narrow those down to the top 30, so you'll get those in this report. And then they drill down and provide you with the best 3 to 6 dividend stocks to buy right now. As far as Capital Ideas, we've got a 30-day trial going. This gives you immediate access to our premium weekly digest. These are the research-based, actionable investment ideas that are reserved for our paying subscribers. You'll get access to 4 issues in our entire archive as well. Find out what you might be missing. Just go to capitalideasmedia.com/30-day trial. Thanks for watching and taking part. If you missed any part of the show, you can watch it on our website or on our Capital Ideas TV YouTube channel, which you're doing right now. A reminder to subscribe to our channel, like this live stream, share it as well. That would be a big help. We've also got a podcast version of the show coming next week. If there's anyone you'd like to see on the show, let us know in the comments section after the stream has ended, and we'll see if we can get them on the program. That is it. I'm Mark Bunting. Thanks again for watching. This is Capital Ideas TV, and we'll see you next time. Take care.